this season, like it or not, Adani Group's latest controversy, which has been stirred because of the Hindenburg research report, is going to hog limelights. So, if you are preparing for your dream jobs, B schools, IAS, it's important that you should be very thoroughly prepared for how and in what manner to defend your viewpoint on the topic of the Adani crisis. Now, whether the report is true or not is something which is going to be the subject of later judicial review or more investigation. So we are not going over there. However, to prepare you for your group discussions and interviews, it's important to understand what were the major allegations. Therefore, to understand the allegations, we like to give you an acronym called SPADE. The SPADE stands for SPADE, and it's almost a metaphoric spade which has hit the Adani Group in some sense. Now, whether that's just or not, whether the allegations are true or not, once again, we are not going over there, but we are just trying to describe what is the spade of allegation. The S stands for stock price manipulation by formation of shell companies and infusing funds to manipulate the share market prices. Now, once stock prices have been manipulated to artificially higher levels, then the P is pledge the stock to get debt. So essentially, you have a stock which would have otherwise, like let's say, be about 100 rupees. Now, through manipulation, you have raised the stock to 1000 rupees price. And now you pledge this stock to get a certain percentage of it as debt from banks. While exact numbers haven't been established, but there are talks that SBI has an exposure of over 20,000 crore, Punjab National Bank about 7,000 crore, BOB about 4,000 crore. Well, these are the rough numbers which are being spoken about. So the usage of overpriced stock to be pledged and therefore get debt from banks because of that is the second allegation. Then A is about accounting irregularities. Now, accounting irregularities have been done on various ways, but then one of the big accusation is that the shell companies which were used to finance this entire process, fund the various investments, are directly or indirectly owned by the Adani Group promoters. Therefore, that breaches the promoter holding norm, including this and including certain irregular payments which were done to these shell companies. There have been various accounting irregularities which have been done to protect this entire scheme. The D then talks about diligence. Very weak due diligence by hiring certain small companies which the report claims weren't skilled enough to handle the work of auditing such a complicated and such a complexly interlinked group. And finally, E is about ethics, that there have been flagrant violations by various members of the Adani Group, both in the past, over the last about 10, 15, 20 years, where they were part of various DRI regulations about illegal transactions. They speak about how certain diamond train transactions were accused in the past and various other cases. So essentially, the entire spade is woven around the group's, well, as the report claims, inclination to do certain unethical transactions just to increase the valuation. So, spade, once again to recap, means S for stock market price manipulation, P for pledging those higher price shares, A for accounting irregularities so that you can hide all of this, D for weak due diligence, and E an ethical portfolio. Now, all of this has been accused by the Hindenburg research. However, well, whether the report is true or not is a matter for a later day research. However, as far as our country, our stock market is concerned, it's quite likely that in an MBA interview you will be asked, what are the lessons for India? And what are also the lessons for the corporate world from the Adani episode? So here, I would like to first of all explain you a brief context that how this shell company model has been working, not just in the case of Adani, but in a generic sense. So typically, the various mechanisms by which the shell company thing would work is that an entrepreneur in a country which has high taxation would then try to, through alliance with some maybe unethical entities, set up a shell company in some of the tax havens. Now, the tax havens could be countries like the Caribbean, even Switzerland, Luxembourg, Panama Islands, where the taxation rate is extremely low or almost zero. So suppose in India, a company has to pay 40% tax. If they were to set up this company, say in Luxembourg, Switzerland, or a tax haven country, the tax could be effectively zero. Now, why is this company called a shell company? The company is called shell company because it has no other transaction except doing this financial entity related transactions between the company which has been the original country versus their own existence in the overseas tax haven. So how this will be operating can be explained in a very simple example. Suppose there is a company A, let's say for hypothetical purposes in India, and now there is company B in the safe haven, let us say Caribbean. So suppose the company A has huge profit, let's say 1000 crores. And in India, were they to be properly taxed, they have to shell out 400 crore rupees as tax. So they would set up, the promoter would set up a shell company in a tax haven country, and the name would be disclosed by having a director who's the face of the company. Therefore, this nominee director ensures that the name of the original owner is hidden. And then this parent company in India would show that some transaction has happened with the shell company. The transaction is essentially bogus in nature. They could show some commodity export, but not export the commodity in reality. They could show some consultancy service where they got consultancy service from that company, but in reality, nothing happened. So, by some bogus transaction, the Indian company would pay a huge cost to this shell company, either directly to the shell company or to another third company who would then give this money back to the shell company. Now, once this happens, let's say 100 crore from 1000 crore profit has been paid to that company. So, Indian company's profit has obviously come down, and this shell company is already in a zero taxation zone, and therefore they don't have to pay any tax on this. What they would now do is they will route the money back as investment. So on the paper, it would look that FDI has come, say from Mauritius or British Islands or Panama Canal into India, but actually it was this owner's own money which is coming back. So this is the transaction by which this money coming back is actually directly or indirectly being controlled by the promoter. But in the eyes of the public, it is an independent neutral transaction. And as a result of this, this money is helping in artificially giving a boom to the price of this share. And as the price rises, well, the promoter can then pledge these shares to get debt from the bank. And whereas he would have originally been eligible, let's say for X amount of debt, now because of the stock price rising, he would get maybe 2x, 3x. And this all wants to operate globally and become a very ethical, gigantic conglomerate needs to ensure that if it has multiple organizations, they need to run at arm's length from each other, which means minimum possible cross holding. And if there are any internal price transactions, they should also be very transparent and at market price. The moment one group is lending excessive debt to the other group without following the arm's length principle, the risk of being controversially sort of trapped in some imbroglio later is very high. Therefore, follow arm's length transactions when it comes dealing between the group companies. There are many groups like the Tatas, the Mahindras group. All the transactions which are happening within the group are really being done at arm's length. So that is the big A. The second B is balance. Now, balance means that you have to use debt, but do not be so heavily leveraged that at a later date you are not able to pay your interest obligations. So, balancing between equity and debt is extremely important. And if you excessively leverage yourself in good times, especially in times when the government is giving stimuli, which was happening in this case, to sort of help the country emerge from coronavirus crisis, almost very low cost debt was available in abundance. So especially in such times of stimuli, a lot of groups could be incentivized and at times even lured to do things which may not be exactly ethical. So how do you maintain your balance between debt and equity is very vital. The third C is cash. No matter how profitable your business is, it's very important that when we are launching new investments, there must be some cash generating entity in the group. In the case of Ambani's, when they were struggling with Geo and various other retail investments, the cash generator was their Jamnagar refinery. In the case of Tata's, in early 2000, when 2005-6 they were struggling with Jaguar acquisition, Chorus acquisition, their cash generator was TCS. In the case of Adani, while their fundamental port operations have been very strong, however, the cash wasn't sufficient to fund the kind of excessive growth, the ambitious growth that they were trying. So, therefore, the absence of the C, a cash generating entity, led to their greater obligation to rely on debt. The D is all about ensuring that your due diligence is done in a very ethical manner. Any group, any conglomerate has to follow diligence very properly. However, it's equally imperative on the government authorities to make sure that any kind of irregularity, whenever spotted, must be very meticulously dealt with. If diligence is compromised, then not just the company, not just the conglomerate, but the nation suffers, as we can see now. The acquisition, whether it's true or not, is now besides the point. The group has already lost roughly half of its market valuation. And India, in certain quarters, in qualitative assessment, is also being put to certain amount of test. Now, we are not trying to link it with a patriotic forum over here. However, the fact is that the entire Sensex, the entire index crashed to a certain extent. Therefore, diligence is an obligation not only of the organization, not only of the conglomerate, however, of the various regulatory authorities. In the past, DRI, SEBI have investigated various accusations. However, probably many of them may not have been conclusive. So, diligence is something which cannot be compromised. And the last E is a very sensitive one. And the term here is exposure and ethics. Now, what do we mean by exposure? The term exposure means political exposure. Time and again, across various forums, certain accusations have been made about Adani Group's proximity to Modi government. Now, none of them have been established, so we cannot say whether it's true or not. But that's besides the point. The point over here is that for a group to gain great stature, it's very vital that the political exposure must be minimal, and therefore neutrality on this front becomes very vital, both for the sake of the group and for the government. And the second and the last part over here of E is ethics. Now, by ethics, I essentially mean efficiency in management. So, even if you're a large conglomerate with a big family structure, try to ensure that the very management of the organization is done in an efficient manner, in an ethical manner. Not to say that any group, out of their own volition, try to break the ethics. Now, how do you introduce ethics in the system? Of course, that is by having strong, powerful auditors, having independent management, making sure that the people who are at the top of the pyramid reach there not because of nepotism, not because of family connections, but because of their global reputation of competency, having a strong independent director board, and also finally ensuring a very powerful culture of trust, transparency, and ethics and fairness. So, once again, the lessons from this particular Hindenburg research episode of Adani Group are A, B, C, D, E, where A is groups need to structure themselves on arm's length. B is balance between debt and equity. C is ensuring that there are cash generating sources. D is strong due diligence, not just as an organization, not only as a conglomerate, but as a nation. And finally, E is ethics, efficiency, so that you are able to manage the business which is above any kind of suspicion. So this is Gagan saying, if you like this video, please press the like button, subscribe button, and stay tuned for more topics to help you emerge with stronger leadership, communication, and placement skills.